In this video, I'm going to explain all the key details of an index fund to help you decide which is the best for you. For this example, I'm going to use Vanguard's FTSE All World Index Fund. As the name suggests, it's a global index fund and one of their most popular funds. I'm going to look at this on a few different websites as the layout will differ, so just to make sure that we're covering all bases and make sure you've got all the key details that you need to know. Now, this is an ETF, so it's an exchange traded fund, and all that means is that it's designed to track a specific index. So the index itself is an all-world index, which is a basket of around 4,000 companies across the world. And all an ETF is doing is trying to replicate that index so you get similar exposure to it. And the idea is it tries to track it as closely as possible. So you're not having yourself, obviously, it'd be virtually impossible for an individual to go and invest in all of those companies themselves. So first thing we're going to look at is the specific code for the fund. So you'll see here it's got a code of VWRP. So you can take this code and you can search that on any platform and you can make sure you're looking at exactly the same ETF. The next thing is that all these popular index funds are going to be listed on multiple exchanges around the world. This one in particular is listed on the London Stock Exchange, as you can see here where it says market listing London. Next, we're going to look at what is actually the fund made up of. So this is, first of all, is top 10 countries. Now, as you can see here, the United States is a massive proportion of the global economy. You can see here pretty much 60% of this index fund is going to be weighted towards the US. And then you can see some of the other countries below: Japan, United Kingdom, China, Switzerland, etc. And you can see those percentages. If you look at top 10 sectors, obviously that's going to give you the industries that they're in, obviously very tech heavy, software, computer services. And then you can look at that even further and you can see a lot of the technology and computer services companies that are going to be here, like Apple, Microsoft, and Nvidia, Amazon, etc. The next thing we're going to look at is the share class for the fund. So you'll see here, this says accumulating. The other version of the fund is going to be a distributing fund or an income paying fund. So there's going to be two share classes for each major fund. Now, all this is referring to is the treatment of dividends. So those companies that the index is tracking, most of them will pay dividends on a regular basis. You've got a choice, right? You can either have that income paid out to you. Generally, it's going to be on a quarterly basis. Or if you're not necessarily looking to have that income paid out and you're just looking to, try and grow this as quickly as possible, then it makes sense to have that income reinvested automatically for you. And that's what the accumulating share class is doing. So that you don't have to do anything yourself. It's done within the fund and it's automatically reinvested back in. And you'll see that the share price in the accumulating fund will generally grow a little bit quicker than the income paying share class because it's also got that income included in it. Now we're going to look at some key details of how this fund is actually managed. So the first thing we're going to look at is this replication method here. Now you'll see a few different terminologies on different websites, so I'm going to use a few different examples. Now here you'll see it says stocks and optimized. Where it says stocks, what that means is that it's actually going in and buying those companies physically. The other alternative is using a form of derivative where it's not actually buying the physical product, it's just buying a contract that essentially gets exposure to that company. So it's not actually holding that physical share. So that's all stocks means. Next, you'll see where it says optimize. So this is referring to a sample. So what this means is that most ETFs will actually invest in a sample of the index. They won't always invest in the whole index, depending on how big it is. Especially one of this size, it makes sense if it can still get the same exposure and same returns of the whole index, but by just investing in a smaller sample size, then it's more efficient for that fund. It's going to be obviously cheaper overall. So that's what optimize means. It's still invested in a lot of companies. So you can see here it says number of holdings 3673. And actually, if we look on Vanguard's website, you can see this quite clearly where this is the ETF here, so 3645 it's got on its website. The actual benchmark itself is just over 4,200. So there's only about 600 that it's not covering. But actually, when you look at its performance compared to the benchmark, you can see here how similar it is. So in red is the NAVs, the net asset value of the fund. In blue, you've got the benchmark itself. So you can see how closely this ETF has been actually tracking this index, even though it's not investing in all of the companies in that index. Just to show you what that looks like on another website. So this is Invest Engine. This is exactly the same fund. So VWRP, we can see here. So the Vanguard FTSE All World Fund. If we scroll down to details here, you see where it says replication method. It says physical optimized. So physical just refers to buying the actual shares, holding those share certificates, and optimized refers to that sampling size. So back to our key data. So the next thing is securities lending. Now you don't need to pay too much attention to this, but I'll just quickly explain what it is. That fund, as a way of potentially producing slightly more returns, can actually lend out those stocks to other platforms and other providers. This fund in particular doesn't decide to do that. And that's all we really need to say on that. You don't need to worry too much about that. Size in terms of the funds, you can see here, this is actually a $30 billion fund. So this gives you an idea of how big that fund actually is. How new is it? So this particular fund launched in July 2019. Let's look at the dividends specifically. So as you can see here, payment frequency is quarterly, so you can get 4 payments over the year. Dividend yield, this refers to the most recent dividend payout. So this is 1.52%, and this is a percentage of income that you're going to get paid on an annual basis. The ex-dividend date and the payment date next. So payment date is obviously when you're going to get paid. Ex-dividend date is simply the date that you need to hold those shares prior to in order to receive that dividend on the payment date. Next thing we're going to look at is the charges of the fund. Now, if we scroll up here, we can see on the right-hand side, it says costs. Now, you're going to see, again, different terminology on each different website. Hargreaves Lansdown here specifically says ongoing charge, and that's what OCF means, is ongoing charge figure. TER is total expense ratio. Essentially, they're referring to the same thing, and all we want to think about this is essentially the cost of the fund. So how much is this actually costing you to invest in? So this cost here is 0.22%. Now, a really key thing with the cost is that you don't actually pay directly this fee to the fund manager. This fee is already stripped out of the fund. So when you see the price here and any performance data, it's already had that fee stripped out from it. So a key part with investing in these funds is that regardless of the performance of the fund, that fund manager will still earn that fee. So it's not linked to the performance of the fund. But from an investor's perspective, it makes it really, really simple because you don't have to worry about directly paying any costs. Obviously, it's already stripped out. It's already done for you. So any performance you see is already taken care of. You'll also see another cost here. It says indicative spread 0.05%. This essentially is referring to the difference between the buy price and the sell price. So you see here, it's got a slightly different sell price than it has to a buy price for a very small spread. Just on that cost side, that is just the cost of the fund itself. Every platform is going to be unique and have their own charging structure. A lot of platforms online now, especially like Invest Engine, Trading 212, have zero transaction fees, i.e. when you put money in, there's no initial upfront costs. Other platforms will still have a fee. If there's any other details that you would like to know about index funds that you feel I may have missed, then please let me know in the comments, and I'm happy to do another video or help you out in the comments as well. Thanks for watching, guys. I'll catch you in the next one.